most Australians will retire poor. And it's not their fault.
And the cost of living strain, particularly the impact that it has on retirees.
Sally, never have inflation figures been so talked about.
Inflation genie is definitely out of the bottle. Those people on fixed incomes and retirees are hurting the most.
The current financial landscape in Australia is setting up most people for a bleak retirement. Inflation is outpacing wage growth, leaving many Australians struggling to save enough for their golden years. But unfortunately, that is the reality for most older Australians. The Association of Superannuation Funds of Australia, also known as ASFA, estimates that for a comfortable retirement, single people need $595,000 in retirement savings and couples need $690,000. But the median super balance for Australians aged between 60 and 64 is only $211,000 for men and $158,000 for women. The good news is, if you're watching this and you're not 65, you still have time to change your situation. Over the past 10 years, I've built a multi-million-dollar property portfolio that set me up for life. And I didn't do it by getting lucky or having a huge inheritance to start with. I did it by investing in property. And I want to show you how you can retire wealthy too. Inflation has been a hot topic lately, and for good reason. It's hitting all of us where it hurts the most. The goal has always been to have inflation around 2 to 3%, but in my opinion, I've always thought it's higher than that. Yes, right now inflation is in fact a lot higher than that. But even when you walked into Coles and Woolies a few years back, your grocery bills kept getting higher despite stable inflation rates. And if you look at inflation versus wage growth over the years, you'll see that we've not really recorded proper wage growth since the first quarter of 2021. You can see here was the last time that we're on equal footing, and then inflation increases and wages don't quite do the same. And with inflation outpacing wage growth, Australians are effectively taking home less money. Think about it this way. If inflation is at 6% and your wages only go up by 3%, you're actually making 3% less that year in terms of purchasing power. Having said all of this though, the market is cyclical. Just a few years ago, we were in a deflationary period. And while that's not the case right now, the key is to adapt and keep moving forward. Because the economy is always going to have its ups and downs, it's a matter of who can roll with the punches and come out on top. When you invest, you're not just thinking about the short-term gains. You're playing a long game. You're setting yourself up for the future. And let me tell you, the people who will be living up in their 40s and 50s, they're the ones who made smart choices in their 20s and 30s, while everyone else was too scared to take a risk. That's why I want to focus on why it's important to start early. You might at this point be thinking the fact that we're pretty fortunate here in Australia because we've got age pension, which yes, means if you're 65 or older and meet the income and asset tests, you can get a bit of money from the government each year. But let's look at what that looks like in reality. A single person is currently getting around $1,100 a fortnight, and a couple is getting around $1,700. If, however, you have income in savings or assets, the age pension payment reduces by 50 cents for every dollar of income above the income-free area threshold. Specifically, for single pensioners, the income-free area is currently $212 per fortnight. So for every dollar of income above $212, the fortnightly pension reduces by 50 cents. And the age pension cuts off completely once your income exceeds the current threshold of $2,444 per fortnight for singles. Now, I get it. Some people will never reach those asset levels, and that's fine. They can rely on the pension. But if you're watching this video and you're in your 20s, 30s, 40s, or even 50s, you shouldn't be planning on how to get the pension. You should be figuring out how to create your own pension through smart investments. Because what happens if inflation keeps going up? The $30,000 you're getting from age pension might not keep up with inflation. So if inflation goes up to say 8% or even 10%, you're going to get 8 to 10% less than $30,000. So that $30,000 might only buy you $27,000 worth of stuff if prices rise by 10%. Suddenly, you're out of pocket by $3,000. And if you have a look at this retirement planner, let's plug in some numbers. Let's say you're 29 years old, you're making $85,000 a year, and you want to retire at 65. You've got around $30,000 in your super, and your employer is contributing 11.5%. And hypothetically, let's say you have a partner who wants to retire at the same age and is earning $98,000 a year and has $40,000. You see here you'll be earning around $92,500 each year from your super balance, which is great. That's a good number. But if you look over here, If you just let that money sit in the bank and drew down on that each year, you'd run out by age 91. And with people living longer and longer these days, there's a real chance you could outlive your savings. And that's assuming you own your own home outright. If you're still renting or paying off a mortgage, things get even trickier. So then what? I'm sharing all of this with you because it's a key fundamental to understand if you want to shift your perspective on this. If you're currently saying to yourself, it's fine, I'll figure that stuff out when it comes to retirement, or I'll just have to adapt to living on the pension, these figures will be your reality. The truth is, most people think you need to earn around $300,000 a year to be considered rich. But if you're just relying on super and the pension, you might be scraping by on $40,000 to $50,000 each. That's not exactly living the high life. And I know you came here to watch this video to figure out how to live on more than $50,000 a year. There are a few ways to do it, but as a property investor myself, I want to show you can do it with property. Now, I'm not talking about buying a dozen properties or anything crazy like that. I want to show you how just with 2 investments, 1 residential and 1 commercial, you can set yourself up for a more comfortable retirement. So we'll stick to the same example as above. Let's say you're 29 years old and over the next 12 months you knuckle down and save up a deposit. You use that money to buy a residential property for $570,000. Now let's assume the residential property grows at a conservative 5% per year. After just 5 years, that property will be worth $723,000. That's a capital growth of $153,000. You can then use that equity towards a deposit for a commercial property worth $815,000. Let's say the commercial property grows at a slightly higher rate as 7% annually, given the potential for stronger returns in the commercial sector. Fast forward another 25 years and you're now nearly 55 and thinking about retiring. Your residential property, which has been growing at 5% per year for 30 years, would be worth around $2.46 million. And your commercial property growing at 7% per year for 25 years would be valued at $5.28 million. Together, that's a total of $7.74 million. That's quite a big difference from your just over $1 million in super without the properties. And all it took was a year of adding to your existing savings. This was obviously a very basic example. And in reality, maybe you'll have to save a bit longer, swap jobs to make sure you're leveraging a high paying job, and sacrifice a year or 2 of lavish living. But the end results, just with 2 properties, are chalk and cheese. Now I know what you're thinking, but what about inflation? And you're right, we do need to account for that. So let's be extra conservative and say inflation wipes out half of those gains. Even then, you're still looking at a combined property value of around $3.87 million in today's dollars. Imagine if you sold those properties at retirement and put the money in your bank earning 4% interest. You'd be generating around $154,800 a year in passive income without even touching the principal. And that's just for one person. If you're part of a couple and you both implement this strategy, you could be bringing in over $300,000 a year. Compare that to the age pension, which tops out at around $40,000 a year for a couple. There's just no contest. And the best part, once you've made that initial residential investment, you can spend the next few years focusing on your career, your family, your hobbies, whatever matters most to you. The property will be quietly growing in the value in the background, setting you up for your next investment and ultimately a dream retirement. Now, I'm not saying it's easy. It requires discipline, sacrifice, and a willingness to take calculated risks. But the payoff is so worth it. Instead of scraping by on a pension, you could be traveling the world, spoiling your grandkids, or pursuing your passions without ever worrying about money. I hope this has helped you shift your perspective a little bit on what's possible when it comes to retiring rich through property investing. If you really want to supercharge your property investing journey and retire with a portfolio that puts you in the top 1% of Australians, you need to know what the big players are doing differently. In this video, I reveal the insider strategies that Australia's top 1% of property investors are using to build massive wealth. I'll see you there.